Let's talk about what all of this means here for the company. We have John Eade, Argus Research President and Director of Portfolio. John, it's great to see you. So just your initial thoughts on this report. So guidance looks like that's coming in a bit light, but FedEx taking even more action in terms of trying to cut their costs even further than we had initially expected.
Right. I think this is FedEx trying to get back on track after the awful quarter they had in their first quarter, when they had withdrawn all of their guidance. So now at least they're providing some clarity and some transparency to investors, even if it's a little bit below what the street had expected. Our estimate was for $13.50 in EPS this year. So we're right in the middle of that range.
Margins were something everyone was watching. What do you make of that side of the earnings report?
Well, FedEx really comes up short on margins compared to other players in the industry, like UPS, right? FedEx delivered a 5.3% operating margin, something like that. UPS is 12.5% to 13%. So for a very similar business, UPS is able to generate a lot more profit than FedEx. Now that can be an opportunity for FedEx. And if they're able to take these costs out of their cost structure, you could see much sharper earnings growth going forward. But that remains to be seen. I think that the new management is still, being questioned on what can actually get done.
Yeah, John, when it comes to the cost-cutting plan, we know that FedEx's now 2023 CapEx spending forecast was reduced by $400 million. Just your assessment of the cost-cutting plan so far and maybe what FedEx needs to continue to do moving forward.
Well, it's partly cost-cutting, but it's also cash shifting. Mm-hmm. When the new CEO came on board, there was an activist investor alongside. They changed the compensation structure to pay more on shareholder returns. They increased the dividend 50%. They set all these aggressive return goals for 5 years, and then everything blew up in that first quarter. So I really think they're scrambling, and they're probably setting the bar pretty low. You mentioned the street estimate was a little bit over 14. Mm-hmm. There's a good chance that FedEx does better than that by the end of the year. But right now, I don't think they want to overpromise and underdeliver, and they're trying to get back in the good graces of Wall Street. And it's probably going to take a little bit of time.
And you mentioned management. Look, it's not easy replacing a legend in Fred Smith. Just ask Mac Jones, the Patriots quarterback. What do you make of Raj Subramaniam and the job he's done there? And can he really cost cut his way to a win?
Yeah, that's a great question. And he is a longtime FedEx exec. And, you can contrast that with UPS, which went out to Home Depot, which is one of the best managed companies in the S&P 500, and brought their CFO over. And she's done a great job of improving profitability, growing the dividend. And I think it might be a little bit easier for an outsider to come in with these kinds of goals than from somebody who's worked side by side in all of these areas that now are facing pretty sharp cuts.
John, when you take a look at these quarterly results here, Raj Subramanian saying that second quarter results were constrained by continued demand weakness, especially what the company was seeing at FedEx Express. And I bring this up because that portion of the business is FedEx's largest. It's also its best known business. What do you think this signals, not just about FedEx, but maybe more broadly what we're seeing industry wide?
Well, yeah, I haven't been able to drill down to the volume numbers yet. But I'll tell you, last quarter, their volumes were off 11%, and they were still able to generate revenue growth, and that's because they were pushing through price increases. Well, I bet the volumes were a little bit softer here in this latest quarter, and inflation is coming down a little bit. So that's going to make that top line growth even stronger, and the company is going to be more dependent on widening margins to deliver EPS growth and EPS targets. But I think that lower volume is something we're going to see when the trucking companies report, when the rails report. right? That's just where we're headed in the overall economy right now.
Indeed. All right. Thanks so much, John Eade. Great stuff. Argus Research President and
Okay.
Director of Portfolio. Appreciate you coming on.